topic focuses on hedging, rebalancing, and investment monitoring within alternative investment portfolios. The topic emphasizes that risk management is a continuous process requiring active oversight of exposures, portfolio sensitivities, and market conditions. Investors must balance return objectives with downside protection, while adapting portfolios to changing volatility, correlations, and macroeconomic environments. Hedging strategies are designed to reduce unwanted risks without fully eliminating return opportunities, while rebalancing maintains target portfolio allocations and desired risk exposures over time. Effective monitoring is particularly important in alternative investments because leverage, derivatives, illiquidity, and nonlinear payoff structures can create rapidly changing risk profiles that require continuous assessment and adjustment. A major concept within the topic is managing alpha, which involves separating active return generation from unwanted market exposures. Investors seek to preserve manager skill while controlling systematic risks that may dominate portfolio performance. Alpha management frequently includes hedging broad market risks through futures, options, swaps, or short positions, while maintaining exposure to desired investment strategies. The program explains that managers often distinguish between portable alpha and beta exposures, allowing investors to combine active management with customized market exposure. Effective alpha management requires careful understanding of factor sensitivities, correlations, and portfolio interactions. Because market conditions evolve over time, alpha preservation depends heavily on disciplined risk controls, ongoing performance attribution, and continuous evaluation of changing investment opportunities and risks. The topic also examines risk management for portfolios containing options and other nonlinear derivative instruments. Option positions introduce complex risk characteristics because portfolio sensitivities change dynamically as market conditions evolve. Key risk measures include delta, gamma, theta, and vega, each representing different dimensions of option exposure. Delta measures sensitivity to changes in the underlying asset price, while gamma reflects changes in delta itself. The program explains that portfolios containing options require more sophisticated monitoring because risks may increase significantly during volatile market conditions. Effective option risk management, therefore, involves continuous adjustment of hedge positions, stress testing, and understanding how volatility changes affect both portfolio value and hedge effectiveness during different market environments. Delta hedging is a central topic within the topic and refers to constructing offsetting positions that neutralize sensitivity to movements in an underlying asset's price. A delta-neutral portfolio attempts to maintain minimal directional exposure by adjusting hedge ratios as market prices change. Because option delta changes dynamically, portfolios must be rebalanced frequently to maintain hedge effectiveness. The program highlights several important observations regarding delta hedging. First, perfect hedging is impossible because transaction costs, discrete rebalancing intervals, and rapid price movements create residual risks. Second, higher gamma positions require more frequent adjustments. Third, hedge effectiveness may deteriorate significantly during periods of extreme volatility or illiquidity. Consequently, delta hedging reduces but does not eliminate portfolio risk under stressed market conditions. The program further discusses rebalancing portfolios with directional exposures and the relationship between mean reversion and diversification. Rebalancing restores portfolio weights to strategic targets after market movements create allocation drift. In mean reverting markets, systematic rebalancing can improve long-term risk-adjusted returns by selling appreciated assets and purchasing underperforming assets at relatively lower prices. However, the benefits of rebalancing depend heavily on transaction costs, market volatility, and asset correlation structures. The topic also explains that diversification reduces portfolio risk by combining assets with imperfect correlations, although diversification benefits may weaken during financial crises when correlations increase sharply. Effective rebalancing, therefore, requires balancing transaction efficiency, liquidity considerations, and evolving market conditions while maintaining long-term investment discipline. The topic concludes by emphasizing the importance of investment monitoring as a critical component of portfolio risk management. Monitoring involves evaluating investment performance, operational controls, manager behavior, liquidity conditions, and evolving market risks on an ongoing basis. The program explains that monitoring should occur across multiple time horizons, including daily, weekly, monthly, quarterly, and annual reviews. Investors must track leverage, exposures, valuation changes, and qualitative information obtained through manager communication and operational due diligence. Effective monitoring also includes cybersecurity oversight, governance reviews, and stress testing of investment systems and processes. Ultimately, successful risk management depends not only on initial portfolio construction, but also on disciplined oversight, rapid response capabilities, and continuous reassessment of portfolio risks and investment objectives.